Hello everyone, I am Samarth Gupta from Bachelor of Management Studies, Keshav Maha Vidyalaya, University of Delhi. In this presentation for financial institutions and market, I will be going to give you an overview about money market. Before going to money market, let us understand what is a financial market. Financial market refers to a marketplace where creation and trading of financial assets such as shares, debentures, bonds, derivatives, currencies, etc. take place. The financial market plays a very crucial role in allocating limited resources in the country's economy. We can classify financial market on the basis of nature of claim, maturity of claim, timing of delivery, and organizational structure. If we look on the basis of maturity of claim, it can be divided into money market and capital market. Money market basically refers to a section of financial market where financial instruments with high liquidity and short-term maturities are traded. That is, the instruments have maturity of 1 year or less. On the other hand, capital market is a place where buyers and sellers can interact and transact financial securities like shares, debentures, debt instruments, where the lock-in period is greater than 1 year. In this presentation, we will be looking in detail about the money market. Features of money market. The money market instruments are highly liquid in nature and short-term in nature. That is, the maturity of these instruments is generally less than a year. Generally, transactions take place through phone, that is oral communication in the money market. There is no formal place like stock exchange as in the case of capital market. Transactions have to be conducted without the help of brokers in the money market. The money market is not a single homogeneous market. It comprises of several sub-markets like call money market, acceptance, and bill market. The various participants or components of money market are central bank, commercial banks, non-banking financial companies, discount houses, and acceptance houses. Functions of money market. A money market performs a number of functions in an economy, which are: first, provide funds. The money market provides short-term funds to the public and private institutions needing such financing for managing their working capital requirements. Thus, by providing funds, money market helps in the development of commerce, industry, and trade within and outside the country. Second, use of surplus funds. It provides an opportunity to the banks and other institutions to use their surplus funds profitably for short period. Thus, commercial banks can further invest profitably while maintaining their liquidity. Third, no need to borrow from banks. The existence of developed money market removes the necessity of borrowing by the commercial banks from the central banks. If the commercial banks find their reserves short of cash requirement, they can call in some of their loans from the money market. The commercial banks prefer to recall their loans rather than borrow from central banks at a higher rate of interest. Fourth, helps government. The money market also helps government to raise funds at low interest rates on the basis of treasury bills. On the other hand, if governments were to issue paper money or borrow from central bank, it would have led to the inflationary pressure in the economy. Next, helps in monetary policy. A well-developed money market helps in the successful implementation of the monetary policies of the central bank. It is through the money market that central bank is in a position to control the banking system and therefore influence the commerce and industry. Helps in financial mobility. By facilitating the transfer of funds from one sector to another, the money market also helps in financial mobility. Promotes liquidity and safety. One of the important functions of money market is that it promotes liquidity and safety of financial assets and thus encourages savings and investments. Equilibrium between demand and supply of funds. The money market also brings equilibrium between demand and supply of loanable funds and thus helps in rational allocation of resources. Now let us look at the various participants of money market, which include central government, banks, that is both central banks and scheduled commercial banks, non-banking financial companies, mutual fund and insurance companies, corporates, discount houses, and bill brokers. Now we will be looking at each of them in little detail. Central government. Central government is mainly a borrower in the money market through the issue of treasury bills. These treasury bills represent zero risk instruments. Due to its risk free nature, banks, corporates, and many such institutions buy treasury bills and lend to the government as a part of its short term borrowing program. Banks. Scheduled commercial banks are very big borrowers and lenders in the money market. They borrow and lend in call money market, short notice market, repo and reverse repo market. We will be looking about what is call money market, short notice market, repo and reverse repo market in further slides. They lend in the commercial paper market by way of buying its commercial paper issued by corporate and listed public sector units. Similar to banks, there are various non-banking financial intermediaries which also lend short-term funds to the borrowers in the money market. Coming to mutual fund, the mutual funds offer a variety of schemes for different investment objectives to the public. There are many schemes which are known as money market mutual fund schemes or liquid schemes. These schemes have the investment objective of investing in the money market instruments. Insurance companies. Both general as well as life insurance companies are usual lenders in the money market. Being cash surplus entities, they do not borrow but basically lend in the money market. Corporates. Corporates mainly borrow in the money market by issuing commercial papers which are nothing but short term promissory notes. They sometimes also act as lender to the banks when they buy certificate of deposits issued by banks or buy treasury bills issued by the RBI. Public sector undertakings. Many government companies have their shares listed on stock exchange. As listed companies, they can issue commercial papers in order to obtain its working capital finance. However, the PSUs are mainly borrowers in the money market and seldom lend their surplus funds. This is due to their bureaucratic mindset. Now, let us look at the various instruments of money market, which includes treasury bills, commercial papers, call money, certificate of deposit, repos. Segments of money market. First, call money market. Call money market is that part of national money market where day-to-day surplus funds, mostly of banks, are traded in. It is one of the most liquid form of money market instruments. The validity is generally one working day. There is no organized market for call money and the transactions between banks generally take place by means of phones, call, email and faxes. The rate at which call money can be borrowed or invested in the market is called as the call rate. Now let us look the main reason that why banks require call money. The main reason is that the maintaining the statutory reserves such as cash reserves. Banks have to maintain liquid cash on day-to-day basis as the mandatory requirement by mostly central banks. In case there is a shortage of liquid cash that does not cover the mandatory requirement at the end of the day, banks turn to the call money market for funds. Various participants in the call money market include scheduled commercial banks, state, district, and urban cooperative banks, Discount and Finance House of India, Securities Trading Corporation of India. Call rate. The rate of interest which is paid on call loans is known as call rate. This rate is highly variable from day to day, often from hour to hour. Now let's look at the treasury bill market. Treasury bills are issued by the central government of the country on behalf of its government. Whenever government is in need of fund, it raises money in the market through treasury bills. These are the most safest investment as they are backed by the government itself. The maturity or tenure of these bills range from 14 days to 364 days and thus are useful in managing short-term liquidity. One of the important features of treasury bills is that they are issued at discount. For example, if the face value of treasury bills is $100, then they will be issued at $95 with a discount of $5. So that when you buy the treasury bill, you have to pay only $95 and at the time of maturity you will get full face value, that is $100. The difference amount of $5 is nothing but the upfront interest earned. Interest is not paid separately on treasury bills and hence they are also known as zero coupon bonds. Treasury bills are also used as a source of controlling liquidity in the market by the government. If the government wants to curb the liquidity in the market, it will issue treasury bills, which will be bought by various financial institutions. By doing this, the investment funds will be backed with the government and will reduce the money supply in the market. On the other hand, if government wants to pump in the money in the financial system, it will buy back its treasury bills by means of which it can inject money into the market. Since treasury bills are considered the safest form of investment, the rate of interest on treasury bills is also known as risk-free rate of interest as used in various models, for example, capital asset pricing models. The treasury bills are available for minimum amount of 25,000 and in multiples of 25,000. Auctions. While 14-day and 91-day treasury bills are auctioned every week on Friday, the 182-day and 364 treasury bills are auctioned every alternate week on Wednesdays. The Reserve Bank of India issues a calendar of T-bill auctions. Commercial papers. Commercial papers is an unsecured money market instrument which is issued in the form of promissory note. It was introduced in India in 1990. Commercial papers are generally used by various companies to finance their short-term working capital requirements, for example, buying of inventory, payment of account receivables. These commercial papers are unsecured in nature, so in case of liquidation of company, they will not have priority against other secured financial money market instruments. All eligible participants have to obtain credit rating for issuance of commercial paper before they issue the commercial papers. Commercial papers can be issued for maturities of between minimum 7 days and maximum up to 1 year. However, the average maturity is generally 2 months. Commercial papers is also issued at discount from face value just like treasury bills. Commercial papers can be issued in the denominations of 5 lakh or multiples thereof. However, a corporate would be eligible to issue commercial paper only if he satisfies the following conditions. First, the tangible net worth of the company as per the latest audited balance sheet should not be less than rupees 4 crore. The company has to sanction working capital limit by banks or all India financial institutions, and the borrow account of the company is classified as standard asset by the financing banks or institutions. Commercial bills. Commercial bill is a negotiable, self-liquidating instrument that is generally less risky in nature. Thus, a bill of exchange contains a written order from creditor to debtor to pay a certain sum to a certain person after a creation period. The maturity period of the commercial bills generally vary from 3 to 6 months. There are various types of commercial bills. First, demand bills and usance bills. Demand bills is the one in which no time of payment is specified. On the other hand, usance bills is otherwise also known as time bill and is payable after expiry of the time specified therein. Clean bill and documentary bills. Bills that are accompanied by document of title to goods are called documentary bills. For example, lorry receipt, bill of lading, etc. Clean bills are drawn without accompanying any document. Inland bills and foreign bills. Bills that are drawn and payable in India on a person who is resident in India are called inland bills. On the other hand, bills that are drawn outside India and are payable either in India or outside India are called foreign bills. Indigenous bills. Indigenous bills are those draw and accept according to native custom or usage of trade. These bills are very popular among indigenous bankers and in India they are called as hundis. Accommodation bill and supply bills. Accommodation bill do not arise out of any genuine trade transactions. These bills generally arise between two parties when they draw bills on each other purely for mutual financial accommodation and then discount them with the banks and share the proceeds among themselves. Supply bills are generally drawn on the government departments by the suppliers for the goods supplied to them. Coming to repos and certificate of deposit. Repos. Repos refers to short-term repurchase agreement. We can understand this with the help of an example. For example, if Bank A is in need of funds and Bank B has surplus funds, now Bank A will enter into an agreement with Bank B for selling its securities and get the required funds from the Bank B. However, this does not end here. There is a twist in the agreement which states that the Bank A will repurchase these securities from Bank B at a fixed future date. These are very short term in nature. They can be just overnight purpose or up to a period of 1 month depending on the agreement between the banks. These are popular among banks because they eliminate the credit risk involved as the securities are directly transferred to one another. Certificate of deposit. A certificate of deposit is a type of time deposit with the bank. Only bank can issue a certificate of deposit. Like all other time deposits, certificate of deposit have a fixed maturity date and cannot be liquidated or withdrawn prior to that date. However, certificate of deposit is a transferable security, which means you can easily sell it to someone else. These certificate of deposits have a specific rate of interest which is higher than the treasury bills. This is because the risk factor is more in this case, and as we know, higher is the risk, higher is the return. Now, looking at after the what is money market, its participants, its instruments. Now let us understand what are the characteristics which will be shown if the money market is a developed money market in a country. The developed money market is a well organized market which will have the following basic or main features. A central bank. A developed money market has a central bank at the top which is most powerful authority in the monetary and banking matter. It controls, regulates, and guides the entire money market. It provides liquidity to the money market as it is the lender of last resort to various constituents of money market. Organized banking system. An organized and integrated banking system is the second feature of developed money market. It is the commercial banks which supply short-term loans and discount bill of exchange. So it is very essential that in a developed money market there is an organized banking system. Specialized submarkets. A developed money market consists of number of specialized submarkets dealing in various type of credit instruments. These are call loan market, the bill market, treasury bill market, collateral loan market, and the acceptance market and the foreign exchange market. Last, existence of large near monetary assets. A developed money market has a large number of near money assets of various types such as bill of exchange, promissory note, treasury bills, etc. The larger the number of near money assets, the more developed is the market. Thank you.